Bollinger Bands are a popular technical analysis tool used to measure the volatility of an asset and identify potential entry and exit points. They consist of 3 lines plotted on a price chart. Middle band. This is typically a 20-period simple moving average, or SMA, of the asset's price. Upper band. This is the middle band plus 2 standard deviations of the price. It represents the upper limit of price volatility. Lower band. This is the middle band minus 2 standard deviations of the price. It represents the lower limit of price volatility. How Bollinger Bands work. Volatility-based indicator. The distance between the upper and lower bands expands and contracts based on market volatility. Expanding bands. When volatility increases, the bands move further apart. Contracting bands. When volatility decreases, the bands move closer together. Key uses of Bollinger Bands: identifying overbought and oversold conditions. When the price touches or exceeds the upper band, the asset may be overbought, signaling a potential reversal or pullback. When the price touches or falls below the lower band, the asset may be oversold, signaling a potential buying opportunity or price bounce. Volatility squeeze. A Bollinger Band squeeze occurs when the bands contract significantly. This indicates that volatility is low and a breakout might be coming soon. Traders watch for a sharp move in price out of this squeeze as an opportunity for a breakout trade. Expansion after squeeze. After the bands squeeze and a breakout occurs, the bands expand again as volatility increases. Trend following. When the price rides along the upper band, it can signal a strong uptrend. Conversely, when the price consistently touches or rides the lower band, it indicates a strong downtrend. Price reversion to the mean. In most cases, the price tends to revert to the middle band or the simple moving average. This means it often moves back toward the average after touching the upper or lower bands. Traders use this tendency for mean reversion to predict short-term price movements. How investors use Bollinger Bands. Buy on oversold signals. If the price touches or crosses below the lower band, investors might see this as an oversold signal. Once the price starts to move back upward toward the middle band, it can be a buying opportunity. Sell on overbought signals. If the price touches or crosses above the upper band, investors may interpret this as an overbought signal. If the price starts to move downward, it could be a sell signal. Using bands for trend confirmation. In uptrends, the price tends to move between the middle and upper bands. In downtrends, it moves between the middle and lower bands. Investors use these levels to confirm the strength of the trend. For example, in a bullish trend, if the price consistently touches the upper band, it signals strong momentum. In contrast, if the price struggles to touch the upper band, the trend may be weakening. Bollinger Band squeeze for breakout trading. When the bands contract, squeeze, investors anticipate a breakout. Once the price breaks above the upper band or below the lower band, they may enter a trade in the direction of the breakout. This strategy works well when combined with other indicators like volume or momentum oscillators to confirm the breakout direction. Example of using Bollinger Bands in trading. In an uptrend, if the price pulls back toward the middle band, which is the simple moving average, and stays above it, this could indicate a good opportunity to enter a long position. On the other hand, in a downtrend, if the price touches the upper band but fails to break through, this can indicate a good time to enter a short position or sell. During a period of low volatility, if the bands contract tightly and the price breaks above the upper band, traders might go long, anticipating a sharp upward move. Similarly, a break below the lower band signals a potential short opportunity. Key points to remember. Upper band equals overbought, lower band equals oversold. A volatility squeeze signals a potential breakout is coming. When trend following, the price riding the upper or lower band confirms trend strength. Mean reversion suggests that the price tends to revert back to the middle band over time. Bollinger Bands help investors spot overbought or oversold conditions, volatility shifts, and trend reversals, making them a versatile tool for timing market entries and exits. Investors can use Bollinger Bands in a variety of ways to time entries and exits based on volatility, trend strength, and price action. Here are the key strategies. Identify overbought and oversold conditions. Overbought, which is a sell signal, occurs when the price touches or exceeds the upper Bollinger Band. This suggests that the asset may be overbought, meaning the price has risen too far and could reverse. Investors might consider selling or taking profits when this happens, especially if the price shows signs of weakness after reaching the upper band. Now, for oversold, which is a buy signal, when the price touches or falls below the lower Bollinger Band, it could indicate that the asset is oversold and may be due for a rebound. Investors can use this as a buying opportunity, particularly if the price begins to bounce back toward the middle band. So, how to use this? Buy when the price touches the lower band and shows signs of bouncing back. Sell when the price touches the upper band and appears to be turning downward. Trend following. In an uptrend, the price tends to move between the middle band, which is the 20-day simple moving average, and the upper band. The price hugging the upper band shows strength in the trend. Investors can use pullbacks toward the middle band as opportunities to enter long positions. On the other hand, in a downtrend, the price typically stays between the middle band and the lower band. The price hugging the lower band confirms the downward trend. Investors can use bounces off the middle band as opportunities to short the asset or exit positions. So, how to use this? Enter long positions when the price is riding the upper band in an uptrend. Enter short positions when the price is riding the lower band in a downtrend. Volatility squeeze and breakouts. A Bollinger Band squeeze occurs when the bands contract tightly around the price. This happens during periods of low volatility and usually precedes a significant price breakout. A sharp move in price outside of the bands can signal the start of a new trend. Now for breakout direction. Once the price breaks above the upper band, it may indicate an upward breakout, and investors can enter long positions. Conversely, if the price breaks below the lower band, it could indicate a downward breakout, and investors may consider short positions. So how to use this? Watch for the Bollinger Bands to tighten or squeeze to signal a potential breakout. Enter long if the price breaks above the upper band. Enter short if the price breaks below the lower band. Mean reversion. Prices often revert back to the middle band, the 20-day SMA, especially after touching or moving outside of the upper or lower bands. This concept of mean reversion suggests that extreme moves tend to correct over time. Investors can take advantage of this by entering positions after the price reverts back toward the middle band, following a touch of either the upper or lower bands. How to use: buy when the price touches the lower band and moves toward the middle band. Sell when the price touches the upper band and moves back toward the middle band. Combining Bollinger Bands with other indicators. Bollinger Bands are most effective when used alongside other technical indicators for confirmation. Here's how investors combine them. RSI, or Relative Strength Index. Combining Bollinger Bands with RSI can improve accuracy. For example, if the price touches the upper band and the RSI is overbought. Above 70, this can confirm a sell signal. Similarly, if the price touches the lower band and RSI is oversold, below 30, it can confirm a buy signal. MACD, or Moving Average Convergence Divergence. MACD can confirm the strength of breakouts. For instance, after a Bollinger Band squeeze, if the MACD shows a bullish crossover, it could confirm an upward breakout. Candlestick patterns. Investors often look for candlestick patterns, like dojis or engulfing patterns, near the upper or lower Bollinger Bands to further confirm reversals or continuations. How to use: combine Bollinger Bands with RSI to spot overbought or oversold conditions. Use Bollinger Bands with MACD to confirm the strength of breakouts and trend reversals. Example strategies. First, the trend pullback strategy. In an uptrend, wait for the price to pull back to the middle band, the SMA. If the price bounces off the middle band and resumes rising toward the upper band, this can be an entry point. In a downtrend, wait for the price to rally toward the middle band. If it gets rejected and starts to drop back toward the lower band, this could be an opportunity to short. Second, the Bollinger Band squeeze. Watch for the bands to contract and volatility to decrease. When the price breaks out of the squeeze, investors can enter a trade in the direction of the breakout, especially if confirmed by rising volume and other indicators like RSI or MACD. Key takeaways for investors: overbought or oversold. Use the upper and lower bands to identify potential turning points. Sell at the upper band, buy at the lower band. Volatility, breakouts. Bollinger Bands contract during low volatility, signaling potential breakouts. Use breakouts from the squeeze to enter trades. Trend following. In strong trends, the price may hug the upper or lower band, allowing you to ride the trend by entering during pullbacks to the middle band. Mean reversion. Prices often revert to the middle band, which can be used for short-term trading opportunities. Bollinger Bands are versatile and can be used across various market conditions, helping investors spot trends, identify volatility, and optimize trade entries and exits.